Another topic we need to discuss is the LIFO reserve. Many companies maintain their internal accounting records assuming the first in, first out cost flow assumption, or possibly the average cost. However, they use the last in, first out cost flow assumption for financial reporting and tax purposes at the end of the period. This is done in order to gain the tax benefits of using LIFO in a period of rising inventory prices. Some companies do not enter the conversion into the books, some do. Some companies report it to a contra inventory account called the LIFO reserve. The LIFO reserve has a normal credit balance in periods of rising inventory costs, which usually is the case over the years. The LIFO reserve is the difference between ending inventory under the first in, first out cost flow assumption and ending inventory under the last in, first out cost flow assumption. We set it up by calculating that difference, and that's the LIFO reserve, and then debiting cost of goods sold. So again, the number here, the amount, is the dollar difference between the ending inventory under FIFO and ending inventory under LIFO. That's what we want the balance in the LIFO reserve to be. Note, if the LIFO reserve balance must be reduced, then there is a credit to cost of goods sold, which increases net income. Let's look at an illustration. See the spirits wholesale outlet illustration earlier in the notes. We're going to use the perpetual inventory system and then see the application of FIFO and the LIFO case. Assume that spirits wholesale outlet uses first in, first out perpetual in the internal accounting system, but reports inventory and cost of goods sold under last in, first out cost flow assumption. Further, assume that the company started 2024 with a zero LIFO reserve balance. Record the year-end LIFO adjusting entry for the company, assuming that the perpetual inventory system and the LIFO cost flow assumption are applied. So again, let's pause the video and go do that work. Keep in mind what you're doing is you're saying, okay, what was FIFO inventory, FIFO perpetual? What was LIFO perpetual? The difference between those is the LIFO reserve, and then record the adjusting journal entry. All right, welcome back. Hopefully you found that pretty easy. So if you looked at your notes, FIFO inventory was $16,200. So that's what the company is using in their internal records. But then they did the work that we did to calculate LIFO inventory, and we found it was $14,750. So the LIFO reserve is the difference between those two. And this is what it would look like in the financial statements. Let's make the adjusting journal entry to get it there. Okay, so the LIFO reserve, put your notes in there, is a contra asset, and cost of goods sold is, of course, a plus expense. And now this establishes the LIFO reserve balance a contra inventory account. If there was already a balance in there, we would have recorded the amount to get it to 1,450 from wherever it was. And that's the LIFO reserve. I find that simpler than it sounds when you read about it. I hope you do too. If you don't, go ahead and reread it in the book. Re-listen to my general video up here as I talked about these notes. Restudy that video, I should say, and then rework the case. Again, there's a million more transactions in the real world, but the concept is the same. You know how to do a LIFO reserve now. Congratulations. Let's talk briefly also about another LIFO topic, and that is LIFO liquidation. Proponents of LIFO point out that the net income is more reflective of true profitability because the cost of goods sold is based on the cost of the most recently purchased units. I agree with that in principle. The LIFO-based ending inventory amounts on the balance sheet are out of date because they reflect older unit costs. So it's a trade-off. FIFO, the net income is less reflective of the true profitability, but the ending inventory balance is more reflective of the real-world value. When inventory declines during the year, we, quote, bite into those older LIFO costs when we're using LIFO, which can distort the profitability measure. That's called a LIFO liquidation. And it serves to overstate real profitability in a rising inventory price environment by debiting cost of goods sold for unit costs that might go back many years. That's a LIFO liquidation. You see them occasionally in practice. All right. Thank you for your attention. A couple of interesting issues. We will now continue into other inventory issues in our upcoming videos. Thanks for your hard work and have a great day.